Hi, Nicholas from DataTrek Research here, and today's topic is the CBOE Volatility Index, or the VIX. Measuring volatility, I've been fascinated with it for decades now, and it really goes back to my time at the old SAC Capital working for Steve Cohen, where I traded the auto stocks. And the traders there taught me how to use options as well as just underlying stock to establish positions, manage risk, and make more money than we could otherwise just trading the underlying. And that's really what fascinated me the most, obviously. We tend to get really interested in things that we make a lot of money with. And that's where I got kind of hooked on options and understanding volatility. And that's the backdrop of how I think about volatility today. It is an important measure of market health. It is a way to understand markets. It's a way to make money from markets. And that'll be what I try to discuss today. We're going to do this in three sections. The first is just some background on the VIX, a little bit of history, and a few numbers to consider. Second, we're going to look at the history of how the VIX is traded because that really informs how we should think about it today. The history is a great guide for understanding what volatility in the VIX really tells us about market conditions. And then finally, we'll wrap up with a few thoughts about what the VIX says about today's market and how we should treat investing in today's market. So a few basic numbers to kick off. The VIX started in 1990, and it was really a response to the volatility of the 87 stock market crash and the growth in listed options trading in the 1980s. Academics and practitioners wanted to understand not just how volatility could be measured historically, looking at how much returns vary day to day, but what the market was expecting for near-term volatility. And that's what the VIX really measures. It's 30-day out volatility on the S&P 500. It's not a prediction per se. It's really a reflection of what the market is thinking volatility will do over the very near term. And it's very deeply grounded in what the near-term history of volatility is. So think of the VIX as kind of a weather forecast. It's, if you want to forecast the weather, the best bet is whatever has happened over the last 5 days will happen over the next 5 days. If it's very stormy, it might stay stormy. If it's very calm, it might stay calm. But of course, weather changes and volatility changes. And so we want to be cognizant of the fact that it's not always going to be the same in the near future as it has been in the near past. And that's what the VIX kind of captures. A couple of numbers that are really important. The first is, since 1990, the average close on the VIX has been right around 20, 19.6, 19.7, we'll call it 20. And the standard deviation of those daily closes is 8 points. And that simply says that volatility starts to get very low below 12, so 20 minus 8, or very high at 28 and 36 and 44, 1 and 2 and 3 standard deviations above the average. So those are the levels to watch. Now let's go over to the history. How much does the history of the VIX tell us of the accuracy of those numbers? So I went back and looked. There's been about 8,400 trading days since 1990, and on only 311 of those has the VIX closed above 36. So that's 2 standard deviation level above the long-term average. You can imagine when those times were. For example, 1990 going into Gulf War I, 2003 going into Gulf War II, 9/11, all saw periods where the VIX traded above 36. Financial crises also on the list, 1998, 2008, 2009, 2011, all periods when the VIX was well above 36. So very high expected volatility. And of course, the pandemic in 2020 took the VIX to an all-time high over 80. So multiple standard deviations above the long-term average. Really just a crazy time, as you all know. The important thing is those were all good entry points for stocks. When volatility and the VIX is very high, that tells you there are opportunities to buy equities that are deeply depressed. It's scary as hell to do it, but that is when you can make good money in those periods of volatility. You don't know when they're going to end, but you do know that eventually stocks will be a good buy at those levels. Now let's talk about the other side of the trade, when the VIX is well below 20, because that's equally important here. If you go back and look at the history of the VIX, you'll find that there are long periods, multiple year periods, when the VIX trades below 20, below that long-term average. For example, 1991 to 96, it averaged 15. 2004 to 2007, it averaged 15 as well. And that long bull run from 2011 to 2019, even including the volatility from the Greek debt crisis in 2011, the VIX averaged 16. So almost half a standard deviation or a little bit more below the long-term average. What do all those periods have in common? Really good stock returns. So the S&P compounded annually at 13 to 18% during all those periods with very few annual losses. You probably have figured out those are bull markets. The VIX trades below 20 consistently in bull markets. It trades well above when there's a crisis, but in between you have long periods of low volatility. Now, why is that? And the answer comes down to correlations. When correlations, meaning when everything trades very much together, tech trades with utilities and healthcare trades with materials and energy, correlations are very high and volatility is quite high because there's nothing to diversify the S&P from a big shock. That's when fear is high. That's why the VIX is called the fear index, because it not only measures volatility, but it really implicitly measures correlations. Correlations become very high because every investor is worried about what's going to happen next. What kind of crisis are we facing? When will it be over? What will the government response be? And that's why volatility is high and correlations are high. Conversely, when things are pretty good, when things are calm, correlations drop. Individual sectors and stocks move in their own directions. That's good because it shows that investors are making bets on fundamentals, not just on big macro concerns. Correlations drop and the VIX drops. And that's what a bull market looks like. Correlations are low, the VIX is low, and that can persist for years, which is why we call them bull markets. They go on for a long time and they can go on until the next crisis. Now, we're summing up the conversation. What do we do with this today, right? Because we want to make some money. The bottom line here is the VIX has been dropping all this year. So in Q1, for example, it averaged 21. In Q2, it averaged 16. In July right now, as we sit today, late July, it's averaging 14. That tells you we're creeping into a bull market. The VIX is telling us things are going to be okay. Volatility is low, correlations are low. So our bias at DataTrek is to say this is the beginning of a bull market. It could change, obviously, but as of right now, the market thinks it has most things figured out. Fed policy, economic growth, the basic variables that make investors confident in investing for the longer term and seeing those correlations break apart. Now, I want to leave you on one important note, though. It doesn't get us out of the woods, because we always have to be cognizant of the other end of this trade, which is when the VIX goes over 20. 20 is the long-term average. If the VIX hits 20 in some summer sell-off or some crisis, that's when you want to take a step back and pause and start looking at how the VIX trades from there. Because ultimately, the important levels on the VIX, we saw this last year, are 28 and 36. The VIX hit 36 once last year. It was in March when Russia invaded Ukraine. That was a geopolitical crisis, but it didn't end up having really profound effects on geopolitical peace. And so the VIX very quickly began to fall again. It made for a good buying opportunity as a trade, but you again had to be very careful because the VIX traded up to 32 to 33 several times last year. Those were all good buying opportunities, particularly the one in October. But the VIX was telling you volatility is high, be careful. So as much as we believe this is a bull market, I do want you to keep watching the VIX because the VIX is going to tell us how sustainable it is. If we get a summer sell-off that goes to 20, that's fine, no problem. If we start going over 20, that's when to watch out. That's when to take a step back. So I hope you liked the video. I hope you found it useful. As always, please like and subscribe if you did. And be sure to check out our work at datatrekresearch.com for more information about us and some more samples of our work in written form. With that, I hope you all have a great day. Bye.